Should I invest everything at once or should I spread my entries over time? This is one of the most common questions in crypto and also one of the most misunderstood, because the real problem is not in the strategies. The real problem is that most people use the right strategy at the wrong time, or they use the wrong strategy for their personality. So in this video, what I'm going to do is I'll explain what the dollar cost averaging strategy really is, what the lump sum investing really means, which strategy works best, which one fails and when, most importantly, and how smart investors can actually combine both for best results. Hopefully by the end of this video you will know which strategy fits you the best, and more importantly when to switch between the strategies. The dollar cost averaging, or you would have heard YouTubers or on social media people calling it DCA, means investing a fixed amount of money at regular intervals, regardless of the price of the project. For example, you have $500 to invest every week from your salary, or you have $1,000 to invest every month, again depending on your salary. So you invest that into the same asset, whether the price is going up, whether the price is going down, whether it is moving sideways. You're not trying to predict the bottom, you're not trying to time the market, you're averaging your entry price over time. The reason the dollar cost averaging exists is simple. Humans are emotional and markets are volatile and unpredictable. So when price goes down, people panic. When price goes up, people experience the fear of missing out. So when you DCA, when you do the dollar cost averaging strategy, this removes the decision making from the process. You don't ask, should I buy today or wait? Is it a good time to buy or no? You simply follow your plan. And just to give you an example, to put that into perspective, let's look at investing into Bitcoin. You decide to use the dollar cost averaging for Bitcoin, and you can spare $1,000 per month for Bitcoin for 1 year period duration. So the total investment would be $12,000. Now imagine Bitcoin's price during that year looks like this. Month 1, Bitcoin is 60,000. Month 2 is 50,000. Month 6 is 35,000. Month 9 is 45,000. It declines. Month 12, it goes back to 55,000 per token. The price is volatile. There is no clear direction. It moves up, it moves down. But because you're using the dollar cost averaging, you buy fewer Bitcoin when the price is high and more Bitcoin when the price is lower. So by the end of the year, your average enterprise for that might be around $47,000. But someone who decided to do lump sum approach at 60,000, they would be still down at the end. This is why the dollar cost averaging is powerful, not because it maximizes gains, but because it reduces regret. And if you're asking me when the strategy is best to be used, it is best to be used in certain situations. I can think of 4 of them. The first one is when you don't know where the bottom is. If you're asking, is this the bottom? You should probably not be lump summing into the project. That's the first. The second is when markets are uncertain or choppy. Macro uncertainty, interest rate decisions, sideways price action. This is where DCA shines. And third, when you are a long-term investor. If your time horizon is like, let's say 3 years, 4 years, or 5 years, or longer than that, DCA reduces stress and keeps you invested. I'll talk about certain projects where this approach would not be best, because sometimes you can keep investing and investing, but the price keeps going down. It would work perfectly with Bitcoin, by the way. With the other assets, we are going to talk about this in a moment. And the fourth case is when you're new to crypto. Beginners should almost always start with DCAing into Bitcoin, maybe Ethereum as well. Avoid aggressive timing. The goal early on when you're just starting is survival. It's not perfection. So DCAing Bitcoin, potentially Ethereum, is the best approach. These are the perfect cases where you can use DCA, but the limitations that come with this approach is that if we look at the downsides, DCA is not optimal strategy in strong uptrends. If the price has been going up for months, and if you try to DCA, that's not the best approach. If the price is breaking market structure, entering a clear bull run, or moving aggressively higher, then DCA can actually hurt your performance. Why? Because you keep buying higher and higher. And another problem is the blind DCA. DCA does not mean buy every altcoin forever, as I just mentioned earlier. Buying every altcoin forever, ignoring token inflation, ignoring fundamentals. If you DCA into bad projects, you will lose money. Not just money, a lot of money. DCA is a tool. It's not a guarantee. It's a strategy that you can use smartly, and it works best for Bitcoin. For the other altcoins, I would say don't apply that. Be cautious. And when you see your altcoin making 2 to 3x, 4x, don't be greedy. Take those profits. There will be a lot of opportunities along the way. This is one lesson that I've learned during my journey. And it has been a mistake even for a project on Discord that we kept DCAing into, and eventually we lost money. But on the opposite side, we had a lot of successful projects like C that we kept DCAing at 60, 40, 80 cents, even a dollar, entry at a dollar, and the price pushed up to $5. But in general, with altcoins, be careful, especially when the price is going up and you're buying because you're afraid of missing out, and also when the price goes down, because that's maybe the case where this altcoin will keep going only downhill. So at some point, maybe just stop, pause, and stay patient rather than keeping to DCA. Even breaking even is a good decision and good choice when you realize that your entry is not perfect. Now let's talk about the other important strategy in crypto, and that's the lump sum. Lump sum means that you're deploying all your available capital at once at a specific price level. This strategy requires conviction, it requires preparation and emotional control, because lump sum investing is not random, it's not luck, it's not guessing. It's decisive. You are saying, at this price, the risk to reward makes sense, and I'm confident that this project is going up from this point onwards. Again, I strongly recommend not going all in, never, regardless of how confident you are, because I can tell you, at some point the market will humble you. You can't beat it all the time. And for those who want to fully master crypto and understand how to play the crypto game, I've created a course. You'll find a link to it in the description below. You can enroll in the course and see the results you'll get at the end. Now let's have a look at an example with the lump sum strategy. Let's look at Bitcoin again. We'll work with Bitcoin right now. Imagine Bitcoin crashes 70%. The sentiment is terrible. We are sitting at extreme fear. The media says Bitcoin is dead, and by the way, this is the sentiment that we are having right now. Everyone is into commodities, into gold, silver, and everyone says Bitcoin is dead, it's crashing. And let's say Bitcoin is trading at right now $90,000. It was 125 just a couple of months ago, it crashed. So if you invest 20,000, let's say dollars, at that level, at 90k, let's say it goes to 180k by the end of 2026 or in the future, it means that you've doubled your investment. Now let's compare that to somebody who is DCAing slowly. They might average in at 100 or 110,000. If it reaches 180k, they wouldn't have doubled their money. They would be at a profit, but not that substantial profit, as if they used the lump sum strategy when the sentiment was at max fear. So lump sum clearly wins in deep drawdowns. The same applies to the altcoins. Once you see altcoin dropping 80-90%, or we see forced selling, forced liquidations, low volume, no hype, this is where lump sum investing massively outperforms. And again, not for every single altcoin, but those that are well established, well known, like you've got Solana, you've got Ethereum, you've got Sui, Sei. These projects, if you go to CoinMarketCap and you sort them by market cap, the top 100 projects, you can use this strategy on those when they are at max fear, when we see forced liquidations, huge red candles. When lump sum is the right strategy, it is the right strategy. It works best in three situations. First, at extreme fear and capitulation, when nobody wants to buy, when nobody is interested in the projects. That's the first. The second, when you have high conviction. You've been around for some time, you understand fundamentals, you understand narrative, you understand technical analysis, you understand the risks. This is essential to build your confidence and to know when to buy and when to sell. Third, early in a market cycle. Early entries reward speed, not hesitation. So these are the three cases where lump sum is the best approach to use. Some of the biggest mistakes that people make when they want to apply one of these strategies is that they use them emotionally. So they lump sum when price is surging, when everyone is bullish, when Twitter or X is euphoric. And they DCA, they use the dollar cost averaging forever, when price is clearly recovering and moving upwards. The opportunity is passing, let's say, and we go down forever. But lump sum is fear of missing out. But dollar cost averaging is indecision disguised as discipline. These two things are important. And the smart strategy is when you try to combine both, and this is what successful and experienced investors do. They combine both strategies. They DCA into core positions like Bitcoin. They keep cash reserves and they lump sum aggressively during crashes, during panic, during capitulation. For example, 60 or 50% of capital allocated via DCA, dollar cost averaging, and 40 or 50% reserved for high conviction opportunities. This gives you discipline, this gives you flexibility, and this gives you upside exposure. And something interesting that I read the other day on X were 12 risk management rules, which I posted on my Discord as well. If you want to join Discord, you would see when I buy, when I sell educational content, technical analysis, and everything to help you become a successful investor as part of the community. I posted these management rules there, and I want to share those with you as well. Never average a losing position. Average down is how small losses become fatal ones. Number 2, always use a stop loss. A trade without a stop is a bet without limits. Number 3, cut losses quickly. Losses must be taken immediately, without debate. Number 4, let winners run. Big money comes from a few big winners, not many small ones. Number 5, trade only when the market confirms your idea. Your opinion means nothing until price agrees. Number 6, never trade on hope. Hope is not a strategy. This is a confession of being wrong. Number 7, risk only a small portion of capital on any trade. Survival comes before profit. Number 8, trade with primary trend. Fighting the trend is the fastest way to ruin. Number 9, sit tight when you're right. Impatience kills profits more than bad entries. Number 10, stay out of the market when conditions are unclear. No position is also a position. Number 11, increase size only when winning. Pyramiding works only in your favor, never against you. Number 12, protect capital above all else. You can't recover if you're wiped out. So every rule was paid for in losses, pain, and blown accounts. This is why I wanted to share those with you. The goal is not to be perfect. The goal is to stay invested, manage risk, and survive long enough to win. There is no single best strategy in crypto. Only the right strategy for the right moment. And it all takes time, experience, and patience. Doing it over and over again until it starts working for you. Thanks for watching. Keep investing smart and keep learning. That's from me today. Thank you. I'll see you in the next video.